Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
$292.96. That was the closing price on the screen as of yesterday, February 14, 2026. If you zoom out just 12 months, this stock, Ciena Corporation, was trading at a low of $49.21. We are looking at a market cap that has swelled to, approximately $43 billion, fueled by a massive surge to an all-time high of nearly $309 just a few days ago. The volatility is, it's historic, nearly 77%. And I want to highlight the implied volatility percentile, which is sitting at 100.
That is a staggering number.
It is. And for those listening who don't spend their days, staring at options chains, let me explain what an implied volatility percentile of 100 actually means. It means that options traders, the people betting real money on future movement, are pricing in more violent swings right now than at any other single point in the last year. It is a fear gauge or maybe an excitement gauge, and it is absolutely maxed out. The market is screaming that something massive is happening here.
The market is certainly screaming. But the question we have to wrestle with is whether it's screaming from excitement or just pure, unadulterated hysteria. We're seeing a stock that has vertically re-rated, and the central question we have to answer today is, I think, simple. Has Ciena fundamentally transformed from a cyclical, frankly, kind of boring telecom hardware vendor into the critical nervous system of the AI era? Or is this valuation the result of a forced institutional chase, driven by S&P 500 inclusion and AI hype that is about to collide with a very hard reality?
I take the position that the market has finally woken up. Ciena has successfully resolved the optical bottleneck in AI clusters. This isn't a bubble. It is a structural re-rating. I see a path where this company doesn't just hold these gains, but potentially sees a 5-fold valuation increase by 2036.
And I take the position that while the technology is absolutely real, the price action is artificial. We are in a perfection phase driven by mechanical index buying, and when you look at the massive insider selling, which, believe me, we will get to, and the looming cyclical risks, paying 62 times forward earnings for a hardware company is, it's a dangerous game.
Let's get into it. For 20 years, investors looked at Ciena and saw telecom. They saw a company dependent on, AT&T or Verizon deciding to upgrade a city network. That view is now obsolete. The reason we were seeing this 200% rally is because the market realized Ciena is now an AI infrastructure play. We spent the last 3 years obsessing over GPUs, buying NVIDIA, buying AMD, but we hit a wall, the optical bottleneck.
I'll keep hearing this term, optical bottleneck. It sounds great in a slide deck, but let's strip the marketing away. What are we actually talking about, physically?
Physically, we are talking about the difference between electrons and photons. For the last decade, connecting servers inside a rack was done with copper cables, electricity. But when you have the new H100 or H200 chips from NVIDIA, they are churning out so much data that pushing those electrons through copper creates massive resistance. Resistance creates heat. Heat kills performance. You literally cannot push the data fast enough through the wire without melting the insulation or losing the signal.
So the pipe is too small for the water.
The pipe is too slow and too hot. That is the bottleneck. You can have the fastest brain in the world, the GPU, but if the nervous system can't transmit the signal to the next chip, the brain is, it's useless. Ciena fixed this. They are replacing those copper connections with optics, light, much closer to the chip. They are no longer about connecting phone lines. They are enabling scale across AI architectures. This is why the stock is up. It's a rational response to becoming the primary enabler of generative AI.
Rational is a very strong word for a 240% return in 1 year. I'm not disputing the engineering difficulty. The switch from electron to photon is real. But we have to talk about why the price is at $292 right now, this week. You mentioned the rational market, but I see a forced market. On February 9, 2026, just last week, Ciena officially re-entered the S&P 500.
Which validates their size and importance. It puts them in the major leagues.
It validates their market cap, sure. But practically, think about what that does to the plumbing of the stock market. It forces every index fund, every ETF tracking the S&P to mechanically buy shares. They don't look at the PE ratio, they don't look at the technology, they just buy because the rules say they have to own it. We are talking about an estimated $9 to $30 billion of buying pressure that hit the book in a matter of days, that overwhelmed the supply. That is a technical squeeze, not necessarily a fundamental discovery of value.
It creates a new floor of ownership, though. Those funds aren't selling.
It creates a temporary spike that traps retail investors. Look at the RSI, the Relative Strength Index. It's sitting at what, 68.06?
Which is high, but not unprecedented.
It is right at the door of being technically overbought. For listeners who don't chart, RSI measures the speed and change of price movements. When it hits 70, it usually means the rubber band is stretched too far and it's about to snap back. And if you look at the Fibonacci support levels, the real support, the 61.8% retracement, is all the way down at $209. That is a long way to fall if the momentum breaks.
Momentum follows growth. If the earnings are there, the RSI resets and the stock keeps going.
Does it, or does the momentum follow the insiders? Because while the funds were forced to buy, the people running the company were selling. Look at CEO Gary Smith. In January alone, he sold heavily. And then, near the highs, he sold over $23 million worth of stock in a single session.
Executives sell for many reasons, though. Diversification, tax planning, it's a 10b5-1 plan, it's automated. You can't read into every sale as a lack of faith.
Stop, please. $23 million. I don't care how much tax planning you're doing. If you truly believe your company is about to become the NVIDIA of optics and go up another 500% like you claim, you do not cash out $23 million. You hold. That sale tells me he thinks the valuation is full. He is feeding the ducks while they're quacking.
Or he's been running the company for 20 years and wants to buy an island. We can speculate on his bank account all day, but I want to look at what they are actually building, because that is what determines the price in 2030, not 2026.
I want to talk about the build, but I can't look past that insider selling. However, if you think a piece of hardware justifies a 62 times forward earnings multiple, tell me why. What is so special about WaveLogic 6 that makes it worth this premium?
It's the extreme version of WaveLogic 6. And the magic number here is 3 nanometer.
The chip size?
Right. Ciena is using 3 nanometer CBOS technology. Now, why does that matter? It's not just so they can brag about having the smallest transistors. In chip fabrication, smaller usually means more efficient. This chip offers a 50% reduction in power per bit.
Which goes back to the heat issue.
Exactly. Think about a hyperscaler like Microsoft or Amazon. They aren't limited by how many chips they can buy. They have infinite cache. They are limited by the electricity the local grid can provide to their data center. They are power constrained. Ciena's WaveLogic 6 cuts the power consumption of the transport layer by half. That means Microsoft can physically plug in twice as much AI compute into the same building without blowing a fuse. Ciena isn't selling cables, they are selling energy headroom. That is the most valuable commodity in the AI world right now.
I get the physics. Energy efficiency is king. But you're painting a picture where Ciena runs this race alone? They have a lead, yes, maybe 12 to 18 months. But in the semiconductor and optical world, that is a blink of an eye. You have Nokia. They aren't sitting on their hands. They are investing €1 billion in 2026 specifically on optical manufacturing.
Money doesn't always equal innovation speed. Ciena has the culture of optics. Nokia is a conglomerate.
No, but money equals capacity. And don't forget Cisco, the king of routers. They have immense resources, and they are already embedded in every data center on Earth. Technology is a game of leapfrogging. We are already hearing rumors of WaveLogic 7, sure, but we are also hearing about Nokia's next-gen coherent optics. If Ciena slips, even by 6 months, or if Cisco comes out with a good enough solution that integrates better with their switches, that premium pricing power vanishes, and suddenly that 62 PE looks absurd.
But the switching costs are high. This isn't like swapping out a brand of coffee. Once you build your architecture around Ciena's coherent optics and their software, you don't just rip it out because Nokia is 5% cheaper.
Maybe not. But let's talk about the hardware you're so excited about from a risk perspective. Supply chain. Ciena is heavily dependent on TSMC for those 3-nanometer chips. Everyone knows TSMC is the bottleneck for the world. But more importantly, they are dependent on indium phosphide wafers.
which are essential for high-speed optics.
They are. But for the listeners, indium phosphide isn't silicon. It's rare. It's hard to refine. The supply chain for NP is a fraction of the size of the silicon supply chain. If demand spikes 500% because of AI, the mines and refiners can't just flip a switch. You could have the biggest order book in history, and Ciena does, with $5 billion in backlog. But if you can't get the raw wafers, that backlog turns from an asset into a liability. Customers won't wait forever.
Backlog is a sign of demand durability, and Ciena has managed supply chain crises before. But you're missing the expansion strategy. They aren't just sitting on indium phosphide. Look at the acquisition of Nubis Communications.
It's a startup they bought.
They spent $270 million cash on that. That is pivotal. It moves Ciena from the middle mile connecting the data centers to the last foot inside the server rack. This is the co-packaged optics play.
Explain co-packaged optics for the audience, because that is a buzzword that gets thrown around a lot.
Sure. Traditionally, you have a chip and then a wire goes to the edge of the board to a pluggable transceiver, that shiny silver box you see in pictures. That distance, even just a few inches, loses energy. Co-packaged optics, or CPO, takes that optical engine and puts it right next to the GPU on the same substrate. It eliminates the copper trace entirely.
It brings the light into the package.
Exactly. And by buying Nubis, Ciena is now competing for the connections between the GPUs, a space that used to be held by chip makers. This opens up a multi-billion-dollar total addressable market that they literally didn't have access to 2 years ago. Nubis is expected to do over $180 million in revenue in fiscal 26. That's 57% growth. They are embedding themselves into the rack.
Smart, maybe, but they paid $270 million for a startup that was barely revenue positive at the time. To me, that smells like a desperate move to buy their way into a market they missed. You call it expanding the playing field, I call it panic buying technology they couldn't build themselves. And again, look who they are fighting there. They are fighting Broadcom. They are fighting Marvell. These are absolute giants who own the socket. Ciena is a tourist in the rack compared to Broadcom.
A tourist with better optics. Broadcom knows chips. Ciena knows like. But let's look at the financials, because ultimately the numbers have to back up the story. You called this a perfection phase, implying they can't back it up. But look at fiscal year 2025. Revenue was $4.77 billion. That's up 19%. EPS was $2.64, up 45%. This isn't a company promising profits in the future. They are printing them now.
The growth is impressive, I grant you that, but is it priced in?
It's the quality of the revenue that's changing. Blue Planet, their software automation division, it finally hit profitability. Record revenue of $115 million. That signals the shift. They are moving from low-margin hardware to high-margin software. Plus, you have the government floor.
You mean the BEAD program?
The BEAD program, $42 billion for broadband expansion in the U.S., and the rip and replace funding to get Huawei out of U.S. networks. That is fully funded now. That gives Ciena a safety net of revenue into 2027 and 2028 that has nothing to do with AI volatility. It's guaranteed government money.
Guaranteed? Sure. Timely? Absolutely not. Have you ever waited for a government check? The BEAD program is a bureaucratic nightmare. The disbursements are slow, the red tape is thick, and the carriers are delaying their orders until the cash actually hits their bank accounts. You are banking on this government money to save the quarter if AI slows down, but the timing mismatch is real. The AI slowdown happens overnight. The government money takes 2 years to arrive. That gap is where the stock crashes.
It provides a floor. Even if it's delayed, it de-risks the long-term hold.
But I worry about the quality of the revenue from a different angle, customer concentration. In fiscal year 25, a single customer accounted for 18% of their total revenue. We can assume that's likely Amazon or Microsoft.
That's standard for infrastructure suppliers.
It's standard, but it's lethal if the wind changes. We are talking about a digestion phase. Analysts are predicting a 20 to 30% pullback in cloud CapEx by 2027. We've seen this movie before. The hyperscalers buy everything in sight for 2 years, the land grab, and then they stop to absorb it. They pause. If AI monetization slows down, if ChatGPT integration doesn't yield the profits they expect, that 18% customer cuts their order in half. Ciena gets hit the hardest.
That's assuming a cyclical bust. I'm arguing for a secular trend.
But look at the margins required to support your valuation. Right now, operating margins are roughly 11 to 17%. To justify a 5x growth thesis, or even the current PE of 62, those margins need to double. They need to hit 25 or 30%. That means they have to operate like a software company while selling hardware. That is a massive if. Hardware margins naturally compress over time as competitors enter. You're betting on them defying gravity.
They are projecting 17% for 2026. The trend is upward. But let's talk about that future, the path to 2036, the $200 billion question.
I'm listening, but I'm skeptical. How do you get a $43 billion hardware company to $215 billion?
You look at the math and the market size. To hit a 5-fold increase, we need a roughly 17% compound annual growth rate in market cap. Can they do it? Look at the TAM, total addressable market. Optical networking is hitting $126 billion by 2035.
That's the whole industry. Ciena doesn't capture all of that.
No, but they capture the fastest growing slices. Co-packaged optics is growing at 31% CAGR. Data center interconnect is growing at 26%. And here is the key conceptual shift: distributed inference.
Which means what?
As AI models get bigger, think GPT-6, GPT-7, they simply don't fit in one server or even one row of servers. They have to be split across campuses. You might have the memory in one building and the compute in another. The optical interconnects essentially become the bloodstream of the entire system. You cannot have a functioning AI without this scale across architecture. The network is the computer. If Ciena owns the bloodstream, they own the system.
Bloodstream is a seductive metaphor, but let's look at history. Ciena's historical revenue CAGR is around 7%. You are asking them to suddenly jump to 15 or 18% consistent growth for a decade. For a hardware company, that is statistically unlikely.
Because the product has changed. It's not a commodity pipe anymore.
It's still hardware, and hardware commoditizes. Always. You mentioned the government floor, but I look at the valuation ceiling. Ciena traded at a discount for 20 years for a reason. Telecom is cyclical. The market isn't stupid. It knows that eventually the build-out stops. If this AI bubble settles, not even bursts, just settles, Ciena returns to being a cyclical vendor. If that happens, the multiple contracts. Fair value estimates based on cash flow are sitting around $230 to $250. We are nearly $50 above that right now.
You're anchoring to the past. You're looking at Caterpillar and telling me it can't fly, ignoring that it just turned into a butterfly.
And butterflies have short lifespans. I'm saying the price assumes the butterfly lives forever.
This is the difference in our timelines. You are looking at the next 6 months of digestion. I'm looking at the next 10 years of data consumption. The amount of data we are generating isn't slowing down. The need to move it is only increasing. Ciena is the toll booth.
Let's bring this to a point then, because we have listeners holding this stock at 300 and listeners waiting to buy.
Go ahead, summarize your caution.
Look, Ciena is a fantastic company. The engineering is world-class, but the stock is a dangerous buy at these levels. You have a trifecta of warning signs. Massive insider selling, $23 million from the CEO is not a tax plan, it's a loud statement. You have extreme over-indexing, where institutional ownership is over 100% due to derivatives. And you have valuation multiples that price in zero margin for error. The easy money has been made. My advice? Caution. Wait until the stock tests that $209 support level. Don't chase the squeeze.
And I will tell you that waiting for a pullback that might not come is how you miss the biggest structural shifts in technology. Looking at historical multiples is a mistake because the business model has fundamentally changed. Ciena is now a core AI utility, protected by U.S. geopolitical interest and the anti-Huawei stance. They are armed with a 1.6 teak lead that is real and shipping. The 10-year horizon supports a massive expansion as the world moves to scale across computing. If you believe in AI, you have to believe in the pipes that make it work.
A utility that trades at 62 times earnings? That's a very expensive utility.
Or a very cheap monopoly on the future of connectivity.
We will find out soon enough.
We will. The next litmus test is right around the corner, March 5th, 2026, earnings report. Until then, you have to decide, is this a hype cycle or the new nervous system of the world?
We'll see you then.
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.